This meeting is now being recorded.
Welcome, everyone, and thanks for joining us today. My name is Tracy Baker, Executive Vice President and owner of CJM Wealth Advisors, and I'm joined by Patrick McGonigal, one of our planners here at CJM. Today, we're going to talk for about 25 minutes about Social Security and answer some questions many people have about the benefits and when to take those. You know, when our parents and grandparents retired, they probably didn't think as much about Social Security. It's likely they just went down to the local office as soon as they turned 65 and applied for benefits without asking very many questions. But today, baby boomers are approaching when to take Social Security in a much different way. So Patrick's going to share some ways to maximize your benefits so you can make the best Social Security decisions for you and your family.
Thank you, Tracy. So as financial advisors, we work with people every day on this issue, and as you may expect, we see a variety of opinions and viewpoints on the program. One theme we see consistently, though, is that many people minimize the value of Social Security. If they understand that they are likely to get something back from the system at all, they believe it will be a minimal amount and not really enough to count on. But Social Security is far more valuable than most people realize. Benefits paid over a 20-plus year retirement can exceed well north of $1 million. Social Security is one of the few sources of income you can't outlive, as it continues until you die. And of course, the longer you live, the more you'll extract from the system. Up on the screen here, let's take a look at a monthly benefit of $2,000 and compare the total lifetime benefits you would receive given a few different life expectancies. We're assuming annual cost of living adjustments of 2.8% per year. That 2.8% is the figure that the Social Security trustees use to project costs and benefits in their projections. So if your benefit starts out at $2,000 per month and you live 10 or more years, you will receive over $276,000 in lifetime benefits. If you live 20 or more years, you'll receive over $642,000 in lifetime benefits. And if you live 30 or more years, you'll receive over $1.1 million over your lifetime. Social Security also offers annual inflation adjustments. This means that your monthly benefit will increase over time. So if your benefit starts out at $2,000 per month, and if annual cost of living adjustments are 2.8%, in 10 years, that same $2,000 monthly benefit will have grown to $2,636 per month. In 20 years, your benefit will be $3,474 per month, and in 30 years, your check would be almost $4,600 per month. Now, there's no way of knowing exactly what future cost of living adjustments will be, but again, 2.8% is what the Social Security trustees are using in their long-term projections.
Now, Patrick, I know there may be some people listening who are saying, you know, I'm not going to live that long, or I don't know how long I'm going to live. And I know Social Security offers another benefit, so that even if you don't live that long, 30 years, maybe your spouse will. And for that, I know Social Security offers survivor benefits. Could you tell us a little bit about that?
Sure. Social Security offers survivor benefits, and what that means is that if one spouse dies while both spouses are receiving their benefits, the widow or widower may switch to the higher benefit. Let's use an example. Joe and Julie are married. Both are over full retirement age. Joe's monthly benefit is $2,000 per month, and Julie's is $1,200 per month. Joe dies. Julie notifies Social Security, and her $1,200 benefit is replaced by a $2,000 per month survivor benefit. So, as you would expect, there are a few rules concerning eligibility for Social Security survivor benefits. First, the couple must have been married at least 9 months at the date of death. The survivor must be at least 60 years old in order to receive a reduced benefit, or full retirement age to receive their full benefit. Survivor benefits are not available if the widow or widower remarries before age 60, unless that marriage ends. Lastly, there are also spousal benefits available for divorced spouses if the marriage lasted at least 10 years. This is a whole other set of rules for this situation, which we won't get into today, but do keep in mind that it may be an option.
That's useful, Patrick. Now, on the previous slides, you've mentioned the term full retirement age. Could you explain that to our listeners?
Sure. Simply put, full retirement age is the age at which a person first becomes entitled to unreduced or full retirement benefits. As you can see from the chart on the screen, your full retirement age is determined by your birth year and ranges from ages 66 to 67. I'd ask that you take a second to find and write down your spouse's and your full retirement ages if you did not previously know them. Knowing your full retirement ages will be a key piece of information to know as we move into some of the different claiming strategies in the coming slides. It's also a critical data point to have on hand as you begin to apply this information in the context of your personal situation. That said, you can apply for benefits anytime after reaching age 62 in 1 month. If you begin taking benefits early, your benefit will be permanently reduced.
Okay, so let's hit on that, Patrick. Let's take a look at an example of what would happen to your benefits if you claimed before full retirement age.
Okay, so if you claim before full retirement age and your full retirement age is 66, you begin receiving Social Security at age 62, you will only receive 75% of your full benefit. You can see that the benefit amount increases each year until your full retirement age, at which point you are entitled to 100% of your benefit. If your full retirement age is 67 and you begin receiving Social Security benefits at age 62, you'll receive 70% of your full benefit, a permanent reduction of 30%. Social Security also uses an acronym to describe the amount of your full unreduced retirement benefit. We'll see the term PIA, which stands for Primary Insurance Amount, pop up on a few of the slides on the video. Whenever we see the letters PIA, this just refers to your Social Security benefit if claimed at your normal retirement age.
Okay, so we know that if you begin receiving benefits before full retirement age, they're going to be permanently reduced. But now, what happens when you delay receipt of benefits until after your full retirement age?
Sure. If you apply for Social Security after full retirement age, you will earn delayed credits of 8% for each year you delay. So if your full retirement age is 66 and you apply at 67, your benefit will be 108% of your full retirement benefit. At age 68, it will be 116%, and so on up to a maximum of 132% of your full benefit at full retirement age. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after 70 to apply for Social Security. If your full retirement age is 67, you could receive up to 124% of your full benefit by delaying until age 70. Now, the two advantages of delaying benefits are, first, you'll get a bigger check when you start receiving Social Security, and second, you and your surviving spouse may get more income throughout your lifetimes.
Okay, Patrick, let's look at an example of that.
Sure. Delaying benefits will give you a bigger check when you begin receiving Social Security. So here's an example. In this table here, we assumed a monthly benefit of $2,466 if claimed at full retirement age, again with 2.8% annual cost of living adjustments. However, you see that because the benefit was claimed early at age 62, the benefit was permanently reduced. After 8 years of inflation, the benefit is only worth $2,307 per month at age 70. Now, what would the benefits look like if the same individual waited until age 70 to collect? That same $2,466 monthly amount would be over $4,000 per month at age 70. Going down the columns, you can see that deferring Social Security benefits not only gives you a larger check each month, but the higher benefit increases more as a result of compounding.
Okay, so should you always delay benefits? Does that always make sense?
Not always. Your need for income, your health, your life expectancy, work status, and spousal needs all play a part in determining when is the best time to begin receiving benefits. If health or life expectancy is a concern, delaying benefits may not make sense. However, your spouse may be blessed with longevity, and this should be a consideration before claiming. But most often with our clients, we see the need for retirement income really driving the decision on when to begin receiving benefits.
That's very useful. Okay, now switching gears a little bit, we've talked about survivor benefits, which involves what happens to benefits after the first spouse passes. But now maybe you could talk a little bit more about what happens with both spouses living.
Certainly. There are two ways for married individuals to claim benefits: on their own individual earnings record or on their spouse's earnings record. Spousal benefits simply refers to the ability for one spouse to claim benefits based on the other spouse's earnings record. So this can be beneficial in situations where one spouse has limited or no Social Security's earnings record, or where one spouse has a significantly higher benefit than the other spouse. One example where we routinely see this with our clients at CJM is instances where one spouse may have left the workforce for a period of time to raise children. So for married couples, the spouse is able to claim a benefit equal to one half of their spouse's benefit. The basic rules to claim spousal benefits are that, first, the primary worker must have filed for benefits. Second, the spouse must be at least age 62 to receive a reduced benefit, or age 66 to 67 to receive full retirement benefits. And third, there are no delayed credits on spousal benefits after age 66. This means that the spouse does not get that same 8% increase by deferring benefits after their full retirement age.
Okay, that's a lot of information. So will you walk through an example, please?
Will do. Let's use an example here with Jane and John. And Jane and John are married. Jane's monthly benefit at full retirement age is $2,000 per month. John's benefit is at full retirement age is $800 per month. So if John applies at his full retirement age, his benefit would be $1,000 per month, based on 50% of Jane's $2,000 benefit. By claiming the benefit on Jane's earnings record as opposed to his own earnings record, John has increased his monthly retirement benefit by $200.
Okay, so, again, it kind of steps back to when should folks apply for Social Security?
Well, that's a good question. There are three key points to consider before applying. First is, if you apply early, your benefit starts lower and stays lower for life. Second, cost of living adjustments magnify the impact of early or delayed claiming, so the longer you live, the more beneficial it is to delay benefits. The decision impacts survivor benefits as well. Delaying benefits may give the surviving spouse more income later on.
Those are useful points. Now that we know a little bit more, though, about how the system works, maybe we could take a look at a few strategies to help the listeners maximize their benefits.
Yeah, a few strategies here. We can start off with one would be improving your earnings record. And what I mean by this is, examine your most recent Social Security statement. Is it accurate? Are there any missing years? Could you improve it by working longer? Another strategy is to apply for Social Security benefits at the optimal time. You should consider your income needs, both now and in the future, your life expectancy, as well as your spouse's life expectancy. You could minimize taxes in retirement. You should anticipate IRA and 401k required minimum distributions, or RMDs, which could bump you into a higher tax bracket. You can also convert traditional IRA to Roth IRAs to avoid these required minimum distributions. You could defer or accelerate income when possible. An example of this may be deferring a bonus or other income until the year you retire, which could result in that income being subject to a lower tax rate. The final strategy here would be to coordinate spousal benefits to maximize the amount you receive from Social Security. We're going to show you a few ways in the coming slides that you can do this. The first way is what is known as the file and suspend, and the second strategy is called filing a restricted application. So let's start with the file and suspend technique. The general idea of this strategy is to file your own Social Security benefit, but then suspend your payments. While your payments are suspended, your benefit continues to increase by that 8% per year. Meanwhile, your spouse files for spousal payments on your earnings record. So the advantage here is higher longer-term payments for you, plus up to 50% of your higher benefit for your spouse. After the first death, the surviving spouse also gets more since they can step up to your higher age 70 benefit. So let's walk through an example to see how this actually works. So we have Bob and Barbara who are married, and both are of full retirement age. Bob's full benefit is $2,000 per month, and Barbara's is $800 per month. Bob files for benefits at age 66, but suspends his benefit until age 70. Okay. Now, Barbara collects her spousal benefit at age 66. Her spousal benefit will be one half of Bob's, and actually larger than her individual benefit. Remember, to do this strategy, Bob must file to do this.
Okay, interesting. Now, what situation would make this strategy work the best?
This strategy works best when one spouse has substantially higher earnings than the other. If the spouse's benefit based on their own earnings record is less than half of the spousal benefit, the file and suspend can be a great claiming strategy. By filing and suspending, Bob is able to allow Barbara to collect based on his higher earnings record while delaying receipt of his benefit until age 70. This 4-year period from age 66 to 70 where Bob is not receiving his benefit allows for his benefit to increase by 32%. So let's take a look at how this claiming strategy compares to some of the more traditional spousal claiming strategies. This is a chart that came out of our Social Security software program here at CJM. There's a lot happening on this chart, but for now, let's just focus on the numbers across the bottom row, as they will show the total dollar value of all lifetime benefits. Recalling the example of Bob and Barbara from the previous slide, we assumed an annual cost of living adjustment of 2.5% per year, and that both Bob and Barbara would live until age 90. So you can see that in this example, the file and suspend results in the highest lifetime benefit, producing a total lifetime benefit of just over $1.5 million. That's going to be the dark blue column at the bottom right of the page. Now, you can compare that number to the lifetime totals if both spouses claim benefits at 70, which is the light blue column to the left, if both spouses claimed at age 66, which is the green column, and at age 62, which is the purple column. You can also see from this analysis that we were able to produce break-even points, which are represented with the green and blue vertical lines on the graph above. The break-even points simply tell us at what age you would be better off claiming under a different strategy.
This is a cool tool. Now, when would you use this with clients?
Yeah, this graph can be a useful tool as it helps determine when to claim based on your personal situation. So it's critical to remember that any projections are based on assumptions such as mortality, cost of living adjustments. So it's really crucial to run an analysis like this based on assumptions that reflect your unique circumstances. Now, this graph is just one example. Ultimately the results are dependent on your own earnings history, but we've seen differences in total lifetime benefits adding up to a couple $100,000 in a few cases. So what's that's the file and suspend. So let's now take a look at the second spousal claiming strategy called filing a restricted application. The second strategy, we can think of this as claim now, claim more later. Here's how it works. At full retirement age, the higher earning spouse applies for their spousal benefit only. The spouse must already be receiving benefits on their own earnings record. When the higher earning spouse turns 70, they file for benefit on their own record.
Okay, now Patrick, can you give us an example of this one?
Okay, so using Bob and Barbara, again from the previous slide, Bob and Barbara are full retirement age of 66. Bob's full retirement benefit is $2,000 per month, and Barbara's is $800 per month. Let's say Barbara files for her benefit at age 66. Bob files for his spousal benefit at the same time and begins collecting $400, which is half of Barbara's PIA. PIA, again, being Barbara's $800, her full retirement benefit. When Bob turns 70, he switches to his maximum benefit of $2,640 per month. Barbara adds on her $200 spousal benefit, which will bring her total benefit up to $1,000 per month. I'll also note here that both spouses cannot do this. The explanation is complicated, but suffice it to say that if one spouse is claiming spousal benefits, the other spouse must be receiving benefits on his or her own record. I should also add that both the higher earning spouse here cannot do this strategy before full retirement age.
Okay, interesting. Now, Patrick, this is a lot of information. Maybe you could boil it down a little bit for us?
Yeah, it's hard to convey all the nuances of Social Security over a PowerPoint slide, so let's take a look at a chart summarizing some of the differences between the two strategies. So in all of this, the million-dollar question is really, what is the best claiming strategy for you? There is no single answer. It depends on a variety of factors, varying from your health to your financial preparedness for retirement. But generally speaking, the file and suspend works well when one spouse has significantly higher lifetime earnings than the other. Filing a restricted application, on the other hand, can work well in instances where both spouses are eligible for Social Security based on their own earnings records. In both strategies, the higher earner must be at least full retirement age, so it's crucial to ensure that you have the income from other sources needed to bridge the gap created by delaying benefits. Okay,
now the Social Security Administration, I'd like to talk to you a little bit about their role. Could you share a little bit, what can you expect when you go and visit them?
Absolutely. The Social Security Administration will estimate your individual benefits, and they'll tell you the amount you are entitled to now. They cannot, however, run projections or recommend appropriate claiming strategies. So it's important that when considering any of these claiming strategies that you talk with your advisor or run projections of these sort on your own. So, with all that said, let me turn it back over to Tracy here.
Great. Thank you, Patrick. You've covered a lot here, and we can conclude that the decision of when to apply for benefits is both important and somewhat complicated. And your decision can literally make the difference of hundreds of thousands of dollars over your lifetime. We're sure you probably still have a lot of questions like, so when exactly do I apply for Social Security? Or what if I want to keep working? What if I've already applied? How can I coordinate my spousal benefits? Maybe what's the long-term strategy for your situation? Or quite frankly, what do you do next? The advisors at CJM can help answer these questions and show you how Social Security fits into your overall retirement plan. We hope this presentation was informative, and we appreciate your sharing your time with us. If there's any way we can be of service, please don't hesitate to reach out to us. And now we got to get to some legal stuff, those disclosures. Be sure to talk with your planner before making a Social Security decision or any other important financial decision. This ends our presentation, and we hope you enjoy the rest of your day.